Good evening and welcome to today's South Market Close Report. Let's dive straight into the numbers. The Nasdaq surged more than 2% to close at 25,820.14. The S&P 500 gained 1.18% to 7,440.43, while the Dow Jones Industrial Average added 0.59% to 52,182.74. The VIX Volatility Index dropped sharply by 4.13% to 17.65, signaling that fear has largely left the building. The 10-year Treasury yield edged up slightly to 4.37%. The dollar index weakened a bit to 101.11. The offshore yuan was little changed at 6.7983. In commodities, WTI crude oil rose 1.17% to $70.30 a barrel. Spot gold fell 0.76% to $4,027.90. Bitcoin also rallied more than 2% to just above $60,352. So what drove this broad-based rally? The single biggest catalyst was Friday's core PCE price index data for May. That report confirmed that inflation is indeed cooling, and the market quickly repriced the odds of a Federal Reserve rate cut this year. The money flow was crystal clear. Funds moved out of cash and defensive assets like gold and utilities and rotated aggressively into growth stocks, especially technology and semiconductors. The so-called risk on trade is officially back. The panic over a June rate hike has been fully priced out. Let's walk through the global trading day. In Asia, Chinese mainland stocks led the rebound. The Shanghai Composite rose more than 1%, and the Shanghai 50 jumped nearly 3%, driven by financial and construction heavyweights. But the Shenzhen Component Index barely moved, up only 0.19%, showing a clear divergence between large caps and the broader market. In Europe, we don't have full data, but based on the strength in U.S. futures, it's safe to assume European markets followed the risk-on tone. Then came the U.S. session. Stocks opened a bit cautious, digesting some hawkish signals from the Bank of Japan, but they quickly found their footing on the back of the PCE-driven rate cut expectations. The session was a one-way grind higher. The real inflection point came about 1 hour after the U.S. Open, when traders concluded that the BOJ's comments would not seriously disrupt carry trades. That's when money flooded into tech. AI hardware names like Nvidia and AMD were the clear leaders. The laggards were utilities and consumer staples, classic defensive sectors. Now let's talk about our forecast from yesterday. We correctly called for a technical bounce after the panic sell-off. But we underestimated the strength of this move. We characterized it as a range-bound session, but it turned out to be a powerful trend day. Our biggest miss was the market's willingness to completely ignore the hawkish BOJ signal and the expanded U.S. export controls on AI chips. Instead of treating those as negatives, the market viewed the chip restrictions as a catalyst for the chip shortage narrative. The market is laser-focused on the rate cut story and nothing else. Looking at the three-way linkage across asset classes, the dollar weakened, the bond market stayed calm, and the yuan held steady. That's a powerful combination supporting risk assets. The strongest sector today was clearly semiconductors, especially AI chips, equipment and packaging. The weakest sectors were utilities, healthcare and traditional consumer staples. For tomorrow, we expect Chinese mainland stocks to open higher and then trade in a range, with the Shanghai Composite facing resistance at 4,100 points and support at 4,030. In the US, the semiconductor index should continue to outperform the broader market. The dollar index is likely to stay weak, trading between 100.8 and 101.3. Gold will probably remain under pressure and may test the $4,000 level. In conclusion, the market has fully unwound the June rate hike scare, and the rate cut trade is officially back in the driver's seat. Our strategy tonight is to lean cautiously long, but we need to watch two key conditions. First, the dollar index must stay below 101.5. Second, the VIX needs to remain below 19. If both hold, we can be more aggressive. That's all for today's close. Thank you for watching and we will see you tomorrow.